All right, looks like it is live. For the first time in almost a year, the Chapwood Inflation Index has finally been updated again. It was not updated for most of the end of 2019 for a number of months towards the end of the year, and it had not been updated at all for 2020. We just got an update out recently. I know because I've been checking the website every 6 weeks, 4 to 6 weeks checking. So if you're not familiar with the Chapwood Inflation Index, it actually is based upon John Williams of ShadowStats' work, and John Williams of ShadowStats' inflation formula is actually based on the old government ways of calculating inflation from both the 1980s and the 1990s, a more honest way of calculating inflation. The founder of the Chapwood Inflation Index is Ed Batowski. I interviewed him a number of years ago. So did Dr. Chris Martinson. He's a hardworking money manager, and there's actually some really interesting reasons for why he started the Chapwood Inflation Index. So in his opinion, it reflects the true cost of living increase in America. Updated and released twice a year, it reports the unadjusted actual cost and price fluctuations of the top 500 items on which Americans spend their after-tax dollars in the 50 largest cities in the nation. The reason that he started the Chapwood Inflation Index is actually a personal one, and unfortunately it hits too close to home for many of us here in the United States listening to this with stagflate and tax and lie. So this is personal commentary here from Ed Batowski. He said, "I am tired." Okay, let me just get to why he started the inflation. I might have the wrong part here on the website. I thought I had it on here. Okay, here we go. Ed Batowski's motivation to create, I was looking at the top of the page on the About section for the Chapwood Index. It's at the bottom. Ed Batowski's motivation to create the Chapwood Inflation Index came from a desire to help people rescue their finances from fixed income despair after the passing of his mother. Ed's mother was divorced, and because of the Consumer Price Index, her alimony payments were under adjusted to the real Consumer Price Index and the cost of living. They failed to reflect her actual cost of living percentage increase year in and year out. Slowly, her ability to make ends meet deteriorated, and she was forced to take a job at Saks Fifth Avenue in order to afford birthday gifts for her grandchildren and other necessities. When Ed's mother was diagnosed with cancer, she suffered through agonizing rounds of chemotherapy and still had to continue working at her low-paying job at Saks Fifth Avenue because she had no other way to meet her financial needs. So she was going to chemotherapy and her job still. Like many of us, she was having to try to figure out how to survive stagflated tax and lie. How did Ed Batowski's mother end up like this? She fell victim to a fixed income based on the flawed Consumer Price Index that failed to accurately reflect the real inflation rate. So that was his goal, to do the Chapwood Inflation Index. It's a survey of 500 consumer items twice per year. And right now, the inflation rate, as you can see there on your screen, the real inflation rate, I would say, the ShadowStats inflation rate, before we talk about the Chapwood Inflation Index numbers, ShadowStats says, according to, this is for free on their website, they have more in-depth behind the paywall. The 1990-based numbers are, with the 1990 formula, dipped briefly below 4% in February and March, and now they're back above 4%, it's trending back up again, looks like above 5 and heading towards 6. But the 1980 formula, which is probably even more accurate because there was a lot of games in the 1990 government inflation formula, making it much different than the 1980 government inflation formula with the CPI. That inflation formula only had the inflation numbers were well above 10%, it looks like here on the chart. Prior to February and March, the crash with the pandemic and the economy collapsing was above 10%. It dropped briefly, looks like, to around 7% or so, and it's trending back up, headed back towards 10. So it looks like it might be around 8 or a little above 8 on the chart there. You can check it out for free. I'll put links to that on the ShadowStats numbers. But the Chapwood Inflation Index, I think this is the most accurate for those of you who are not familiar because it surveys a lot of different consumer items. It tends to analyze stagflate and tax and lie better. And for those of you who believe the Keynesian numbers, who believe the Consumer Price Index numbers, by the way, the economists at the Federal Reserve are projecting much higher CPI numbers. I had a hedge fund contact send me the Fed projections for much higher CPI numbers in the next 12 to 18 months. They're projecting the official CPI numbers to get as high as 3.9%. So they're projecting a lot more inflation on the CPI. They have different case numbers. So they have the CPI going well above 2% at like 2.7, and then they have a much higher number that they're shooting for of about 3.9% sometime in 2021. So they are projecting, even the Fed people. So while the talking heads and on TV and the financial professionals and all these deflationistas like Jeff Snyder and Dr. Christopher Dark, who I had to block on Twitter because he cherry-picked data and then accused me of cherry-picking data because he paid $1,600 less for a new computer, and he cited that one data point as cherry-picking data that there is no inflation. He doesn't live in the United States. He lives in Hong Kong. And I don't even think he has an economics or business background. He didn't even know what the Cantillon Effect was, and we'll talk about that in a little bit. But the real inflation rate, in my opinion, the Chapwood Inflation Index, shows that for the first half of 2020, there was inflation rates of 8.1% per year in Phoenix, and as high as, let's see here, the highest one I think was actually in Seattle and Washington, D.C. Nope, San Francisco had 13.3% first half of 2020 before the pandemic kicked in. And Washington, D.C., let me get here, 11.7% for the D.C. metro area. Seattle, also Portland and Seattle had very high inflation rates as well. So Seattle was 12.3% for the first half of 2020. Portland was 12.1%. Basically, it's in a range between 8.1 and 13.3. There's a lot in there of high inflation rates. The 5-year average inflation rate is also, again, in similar numbers there, between low to mid 8s and 13% per year inflation. This is when you add in all the cost of living increases for healthcare costs going up, food prices, portions shrinking. What the CPI does not do, and the CPI is incredibly flawed, but Keynesian economics is also incredibly flawed. The mainstream is incredibly flawed at accounting for inflation because they mistakenly assume that inflation is evenly distributed, that there can be a 2% inflation rate for the whole economy for all goods and services. So with Dr. Christopher Dark there, who was trying to annoy me on Twitter before I blocked him, saying that, okay, I cited one counterexample, I cherry-picked one piece of data that shows that prices fell, therefore you're wrong about inflation. But that's not how real life works. And real life works, according to the Austrian School of Economics, it actually predated the Austrian School of Economics. It was by the richest person in the world at the time. His economic analysis and writing was so well respected that historians now agree that Adam Smith plagiarized the entire first chapter of Wealth of Nations from his writings, Richard Cantillon. It's the Cantillon Effect, and one of the most important parts of Austrian School of Economics is the Cantillon Effect. So if you are not familiar with the Cantillon Effect and you're arguing with a deflationista who is making lots of money off of the corruption, off of trading bonds, and has some falling prices in their life, and maybe is not as subject to stagflate and tax and lie on their food and healthcare and other costs of living, and politicians are not forcing wage and price controls and taxes and other ridiculous things upon them, then you could tell them, you will lecture them then about what the Cantillon Effect is, or send them some pieces to read. The Cantillon Effect says that the people who are getting the currency and the credit first, they are the ones that will dictate prices and create even more distortions. So for example, then, the people here in the Washington, D.C. metro area and the federal government employees, all these overpaid bureaucrats and government employees here, they are getting the currency and credit first because the government doesn't cut back during a recession or depression. In fact, that's the Keynesian economics diagram and MMT want the government to spend more. So you have even more spending. So all that spending here in the DC metro area, that's going to affect real estate prices. It's going to affect real estate prices a lot. And a lot of real estate investors then are going to respond to that. And they're going to say, because of this, real estate prices here in this area will not go down. And for the last 10 or 12 years, they've basically been right. Now, that doesn't mean that won't change, that prices ultimately in this area won't start to fall at some point. We're already starting to see some evidence here after talking to my best friend who is a real estate agent that prices could go down. But The Cantillon Effect says that inflation prices are not evenly distributed, but you have all these people in the mainstream, all these Keynesian economists, the CPI, all claiming that there has to be a 2% evenly distributed inflation rate. But the Cantillon Effect says, that's not how inflation works in reality. In reality, certain groups, so either Wall Street, hedge funds, federal government employees, government agencies, they get to spend the new currency created and the credit first. And then that causes higher prices in certain things that may or may not go up to certain amounts. And then it causes even more distortions and unintended consequences and misallocations of capital. So we don't know how it's going to affect all the different prices. It could, at some point, with all the different currency creation, it could, for certain prices, could go up either a little bit or not at all. Some prices, like stocks, certain stocks like technology stocks, real estate, those in certain areas, those prices may go up a lot, and other prices may only go up a little bit. But then with the Cantillon Effect, you could have situations where there's no income, no consumer discretionary income, no savings to afford consumer discretionary items, and those prices may collapse. That is still, according to the Austrian School of Economics, inflationary, according to the Cantillon Effect. So you can have really, really bad stagflation on certain items like food and healthcare and other things. Also, with the Austrian School of Economics, Ludwig von Mises said something that I think is very important, and I'm going to add a little bit to it here based on personal experience, that Ludwig von Mises has said that inflation is 100% government created. Now, a lot of Austrians will say that it's based on currency and credit creation only, but let me add into that with government creating inflation. Governments can also create higher prices, higher costs in supply chains for the consumer in other ways besides creating more currency and creating more credit. Governments can put tariffs on things. Governments can tax things more, forcing costs higher. Governments can also put wages and price controls. So this is all government intervention, government pulling levers with new currency and credit creation, trying to force prices higher on certain things, or trying to force costs higher on others for businesses or consumers or savers or investors. So inflation is 100% government created, but it's not all just currency and credit. It's other government intervention into the economy. If there wasn't government intervention into the economy, and we were in more of a vacuum system, vacuum of an economy here in the US, where the US did not have to import a lot, the Achilles heel of the US economy right now, one of the major Achilles heels, is how much the US has to import goods. So food and other goods and services from other countries. And those other countries are also devaluing their currencies, either intentionally devaluing their currencies, or since February and March, their currencies have devalued a lot, been devalued a lot by the market, by the currency exchange rate mechanism, by currency traders. And that currency devaluation of, say, the Brazilian real against the dollar, although it's rallied recently, it was still down from, I think, February or March. It was down over 20% at one point. The Mexican peso was down a lot against the dollar. Those currency devaluations are going to leak into different supply chains in different ways, creating more unintended consequences, more higher costs. And then when the U.S. imports goods that are manufactured in Brazil or in Mexico, those costs are going to be higher. We're seeing that now with Brazilian soybeans. I believe the cost of Brazilian soybeans is up 14% recently. That has to do, at least partially, with currency devaluation. So the CPI is incredibly misleading. It's designed to underreport inflation. It does not reflect reality. If I remember correctly what Danielle DiMartino Booth said, the CPI actually counts for healthcare. For healthcare costs, they count the government paying subsidies for Medicare and Medicaid. So if you have a healthcare plan for your family and your costs go up over the last 4 or 5 years from Obamacare, I've had friends where they were paying the healthcare bills for their family of 4, and the healthcare bill went from like $12,000 a year for a family of 4 or 5 people up to like $26,000, and they had to get a worse healthcare plan. And the CPI does not account for any of this stuff. This is how bad the CPI is. Danielle DiMartino Booth has actually disclosed in her book, Fed Up, that there's internal Federal Reserve discussions with James Buller, the vice president at the Fed, and others that know the CPI screwed up, but they won't say that publicly. So in private, they say that they know the CPI screwed up, but you have all these talking heads, all these financial professionals on TV, all these PhD economists, all saying there is no inflation. We're going to get inflation at some point. We're going to get stagflation. Meanwhile, the people on Main Street are just getting killed for years now with higher costs and shrinkflation and stagflation in a lot of key items. So yes, maybe there is some free market forces with laptops and with computers, although I think there's some subsidies involved for some countries about manufacturing chips and other pieces of technology. Some countries protect their domestic industry and subsidize it and artificially eat the costs. They keep the costs low. So that might factor into part of the prices. But there's a lot of factors that go into production costs. So I had one person online tell me that if oil prices crash, there won't be any inflation in anything. That's not true. Okay, the energy and input costs are only one piece to the puzzle for manufacturing a good. You also have labor, you have all these other, you have wages you have to pay the employees, you have labor, you have taxes, the government can force higher minimum wage laws. You have all these things that go into running a business and producing a good or a service. And the government is trying to force, many governments are, these costs higher. Because this is what governments historically have done. So the Cantillon effect is whoever gets the currency and credit first, they're going to create distortions, and they're going to often drive up, they're going to spend the purchasing power of the currency first, and they're going to drive up prices. So Richard Cantillon, he was involved, he's the only person, I think, to successfully ride up two enormous historical bubbles. He was involved in John Law's Mississippi bubble, and then also the South Sea bubble. So he saw firsthand that all this currency creation, it just created a massive amount of demand and purchasing of the shares. The Mississippi bubble shares, it drove the prices up. People were borrowing to speculate on the shares. And then it created just further distortions and a higher cost throughout the economy. Now, not everything was higher cost, but it just created just massive amounts of misallocation of capital and distortions. And then there was, of course, a bust and a bubble. So he saw all these things happening. He's one of the few people to actually profit and short to ride up two enormous bubbles like that. The Mississippi bubble from John Law and the South Sea bubble. He rode up both bubbles and then shorted both bubbles successfully. Okay, question here, super chat, not super chat, question from Michael. Money velocity is the only equation the Fed cares about. The problem is the Fed is only measuring money velocity in the banking system. And the US, you can have, if you look at financial history in a lot of major countries, there's been inflations, stagflation or worse, worsening stagflation, worsening stagflation, potentially hyperinflation without lending increasing in the banking system. This is something that Jeffrey Snyder and many of the other deflationists miss. The US's Achilles heel is imports. So if you have the dollar tug of war now, where the dollar index is still at 93, but you can have a lot more inflation based on how much the US has to import. And the current money velocity measurements that are measuring in the banking system are not going to measure this. And in past increasing inflations in other countries, they didn't measure this either. If you study the past great inflations in many other countries, there actually wasn't a lot of increase in lending in the banking system. The inflation came from imports. The imports just became more expensive because the home currency was being devalued. Now, the US has a world reserve currency, so the odds of a hyperinflation soon are lower than in another country like, say, Venezuela or Zimbabwe or some of those other countries that had really, really bad inflation. But that doesn't mean the US can't have really, really bad stagflation that's going to get worse in the not too distant future. And those price costs are going to come from importing goods and services, because other countries are also doing stagflate and tax and lie. See, currency wars, what most people don't understand is that currency wars, stagflate and tax and lie, and the dollar tug of war are all related. They're all related. And this goes back to a lot of the problems from the 1920s and the 1930s with beggar thy neighbor. and the way the current global financial system is set up with the dollar standard. So you have all these other countries that are basically propping up the dollar for different reasons, and they want their currency devalued. They want to control the devaluation, but they still want their currencies weaker than the dollar because they want to boost exports. So all these other countries are trying to do this, and you have all these other trade partners that the US has, and they've had their currencies devalue substantially against the dollar since just February and March. And those devalued currencies are going to start to leak into supply chains, especially items that the US imports a lot of. And it's not going to show up in the CPI probably. It's going to show up in shrinkflation. You're going to have a lot less goods and services for your currency, that's for sure, in the years to come. So you can have a lot worse stagflation without money velocity. In fact, if money velocity picks up, you can go, like what Dr. Lacey Hunt says, you can have way worse than stagflation if velocity of money actually picks up. The majority of the inflation here in the US is going to come from other countries devaluing their currency more against the US and then forcing costs higher in the supply chain. And then if politicians, because inflation is 100% government created, and then if politicians here in the US force higher wage and price controls, higher minimum wage laws on business owners, they're forcing higher costs. So that's going to put even more cost pressure. So you have more currency and credit right now globally. All this currency and credit has been created, and you have less supply of many goods. There's a lot less production than there was before the pandemic. Unless you want to count the manufacturing out of China of N95 masks and medical equipment and vaccines. But overall, there's way, way less supply now of goods than there was before the pandemic. So now you have more currency and credit chasing less supply. People are not thinking of things that way. The deflationists are just saying the banking system, there's no lending in the banking system, and that proves that there's deflation. Yes, if we were in a vacuum, if the US did not have to import, if the US had a closed economy, if the US did not need to import all this food and other raw materials, yes, the US would have a lot more deflation. Although I don't think the politicians would allow it then. I think the politicians would figure out more ways to force costs higher. But yes, if there was more of a closed system here in the US with the economy, the US was not importing nearly as much. The US has to import a massive amount. Lynn Alden has covered this extensively. Lynn Alden had a really good article at the beginning of August about how much the US has to import, how many goods, and the massive trade deficit the US has to run. A lot of it is from goods that the US has to import. Jeff says the USA exports more food than imports. The US does export a lot of food, but China's not buying nearly as much food. Also, a lot of the US's trade deficit was actually benefited from shale oil, and who knows what's going to happen with that. So the actual trade deficit might have even been worse if the US government wasn't subsidizing shale oil. And I've touched on an article for patrons about how Beggar Thy Neighbor and Currency Wars and Stagflate and Tax and Lie all work with the dollar tug of war. It's in the last month or so. Talking about how other countries are being hit with currency devaluations and inflation more than the US right now, but the US is going to be importing more of that in the near future. So there is an enormous discrepancy between the consumer price index, which I think they're going to keep changing the formula. George Gammon has covered this extensively. They're going to do the chain CPI. They're going to keep pulling their substitution, hedonics, and geometric weighting now. They're going to add in this chain CPI to keep reducing the amount of inflation because it's all tied to cost of living adjustments, like what Ed Batowski was saying with his mom. So there's all these people getting Social Security checks and government employee pension plans, all tied to the consumer price index. And if they were more honest about the real inflation rate, the government would have to pay out even more in those transfer payments, those social payments, social transfers. So it's in the government's incentive for a lot of different reasons to underreport inflation. And this is part of Stagflate and Tax and Lie. And there's a lot of historical precedent of governments doing this all over the globe. Underreporting inflation, even before there was any paper money and it was gold and silver as money, governments were clipping coins. which was an early version of stagflating. Small amounts of inflation that most people hardly noticed. And then government's lying about it. Okay, so if you want to check out the Chapwood Inflation Index, the links will be below the video. I kept this below 30 minutes. If you want to read about the Cantillon Effect, again, in my opinion, the Cantillon Effect is one of the most important parts of Austrian School of Economics because it explains exactly what happens with misallocation of capital, distortions, and all this currency and credit going into asset prices and just creating further distortions and misallocations of capital. And then the unintended consequences of certain prices either not going up at all or going up a little bit, other prices going up quite a bit, other prices going up a lot, and then other prices crashing. And the Keynesians don't understand, the mainstream financial professionals and the Keynesians don't understand any of this because they have been taught that inflation is supposed to be evenly distributed. So if you have a counterexample, if you are a mainstream financial professional or a Keynesian, and you have one counterexample where there is no inflation. But with the Austrian school and the Cantillon Effect, it proves that that's not true. That in an inflationary environment with currency and credit created like crazy, there's going to be all kinds of unintended consequences, all kinds of distortions, all kinds of misallocations of capital and prices. Some prices are going to go up a little bit, some are going to go up a lot, and some are going to crash for different reasons. And this is something, unfortunately, that I'm just tired of arguing. I think a lot of people, I could send articles about the Cantillon Effect to Jeffrey Snyder or Dr. Christopher Dark, their minds, or Dr. Lacey Hunt, their minds are made up. They don't care. Most of them are not going to care. They're going to dismiss it. But I trust Richard Cantillon, who was arguably the richest man of his time, and his economic analysis and writing was so good that Adam Smith plagiarized an entire chapter of one of the most famous books in economics with his writings, Wealth of Nations. So the entire first chapter of Wealth of Nations was plagiarized directly from Richard Cantillon. That's how good Richard Cantillon was about writing and understanding how governments and central banks and the economy and prices and investing and trading in markets work. The man is very, very underrated. One of the greatest economic thinkers of all time. Okay, so the Cantillon Effect, unintended consequences, measuring things like the Keynesians try to do with a CPI and 2% inflation rate. Maybe in the past it was more honest because they were measuring a stable set of goods, but nowadays that is no longer the case. I want to thank everyone for listening. I do have a lot of content behind the paywall, well over 100 pieces of unique content for only $5 a month. You can check out my Patreon. And also, if you want a tip, a one-time tip, it's available on my website through PayPal.